confronting the fears of a gold-backed currency. To bring back the gold standard effectively, we must first address the immediate value mismatch between current U.S. gold reserves and the amount of money in circulation. With $2,259.3 billion in circulation and 262 million troy ounces of gold in reserve, the value of gold would need to rise to approximately $8,625 per ounce to fully back the currency. This recalibrated value ensures each dollar in circulation is supported by a fixed amount of gold, eliminating reliance on fiat currency while providing a strong intrinsic backing. By setting a higher, controlled price for gold, the currency would gain stability and retain a store of value, fulfilling gold's historical role while adjusting for modern economic needs. To mitigate gold's limitations on economic growth, a strategic adjustment mechanism would be implemented. Rather than a rigid one-to-one gold backing, a flexible reserve ratio could be introduced to accommodate economic expansion. This would allow a slight increase in currency issuance relative to gold reserves during periods of economic growth, with strict caps to prevent inflation. For instance, if the economy grows by 2% annually, the reserve ratio could be adjusted by a proportionate amount, allowing for a controlled increase in money supply. This flexibility supports growth without undermining the backing standard, ensuring the gold-backed dollar adapts to expansion needs while maintaining stability. To prevent deflation, gold-backed digital credits could be introduced, representing fractions of gold that can be used in transactions, helping to avoid liquidity issues without creating additional physical currency. To counteract susceptibility to market manipulation, this system would require regular audits and global price stabilization agreements with other gold-holding nations. By establishing a cooperative framework, countries can collectively stabilize the price of gold, limiting its vulnerability to speculative market forces. These agreements would involve setting a stable trading range for gold, ensuring that its value remains aligned with economic indicators, rather than fluctuating due to speculative or geopolitical pressures. Such international cooperation would reduce the risk of any single country influencing gold's price excessively and would maintain fair, predictable currency stability. Additionally, implementing transparent digital transactions backed by gold would increase accountability and confidence, reducing the chance of manipulation by maintaining traceable, fixed-value digital credits tied to gold. In times of crisis, flexibility would come through a gold bond system. These gold-backed bonds could be issued as temporary currency supplements, backed by the gold reserves, but without altering the physical gold holdings. For instance, in an economic downturn, the government could issue bonds representing future gold value, ensuring liquidity without compromising gold backing. These bonds would have a fixed redemption rate tied to gold's future value, assuring investors while creating a reliable emergency response mechanism. As an additional safeguard, the U.S. could increase its gold reserves over time, reducing dependence on foreign gold by investing in domestic gold production. With a phased approach to increasing reserves, the U.S. could maintain a stable gold-backed currency without being overly reliant on foreign sources, thereby ensuring the system's resilience, adaptability, and independence.